Hello dear children. Now in this video we will discuss about money, its meaning and functions. Okay. So this chapter is very simple first of all, and few things have been removed, just like barter system, which is very simple. Okay. Kinds of money, I mean the types of money. This importance of money and the difficult section, that is the components of money supply, it has been removed. Okay. So let us see what is money. So generally speaking, okay, whenever we talk about money, okay, we think of the cash money or the money that we have in our bank account, isn't it? So that is your money. Okay, how much money you got? Only rupees 20, only rupees 50 or 100 or 500. Okay, we say this way. So that is basically the money. Okay, the concept of money that we have. But what about the money in terms of economics? Okay, so in terms of economics, money is, it is something which is generally accepted as the medium of exchange. Okay, and at the same time it should be noted that it is a measure of the store of value. Okay, because you know uh, because we can exchange the goods and services against the money, isn't it? Like you want to purchase a pen, let us suppose. Okay, you want a pen, a commodity, then you go to the shop, okay, and you pay the shopkeeper rupees 10, and the shopkeeper will give you a pen, right? So this way money, it acts like the medium of exchange. Okay, you want to purchase a pen, you give rupees 10, and the person, the shopkeeper, will give you the pen in exchange, okay, in return. So this is how the money, it acts like the medium of exchange, and at the same time it acts as a measure of, it acts as the measure. Okay, like what do you mean by measure now? By measure, we are actually talking in terms of the finance or in the monetary value. Like you can measure the value of anything in terms of the money. For example, uh, the price of YY is rupees 10, isn't it? It is 10. And the price of Maggie is 12. So this is the measurement. Okay, what is the price of Maggie? And let us suppose that 1 kg tomato, it costs rupees 40. So then what will be the price of 2 kg, 3 kg? So we can measure this way. Okay, and it acts also like a store of value. Now by this value, we mean that okay, let me just give you a very simple example. If you store 10 rupees note, okay, if you just keep it, okay, if you just hold it, this 10 rupees note, okay, uh, in your wallet, and you use it after 5 years, okay, you pull it out after 5 years, so still that 10 rupees note will possess the same value of 10 rupee only. Okay, that nominal value will not be decreased. So this is the meaning of the store of value. Okay, that 10 rupee note, okay, which you have saved in the year 2022, okay, and in the year 2027, when you use the same note, it will be accepted. Okay, until and unless there is the demonetization of the old currency notes. Okay, but that money, okay, it will be stored as the measurement, sorry, uh, I mean the value of the money, it will be stored for a longer period of time. Okay, it will never be depreciated. Okay, however, in case of the foreign exchange, we have seen this appreciation and depreciation. That is about the international market. Okay, whenever we talk about money, we have to think uh, in accordance to the home economy, okay, or the home country. Okay, now this is the first basis, then you go to the international level. Okay, first you understand in the home country, then you go to the international level. Okay, now what is money, basically? Now, so what is the definition of money? Now money is a matter of four functions. Okay. Uh, okay. This poem, it is a kind of a poem you can see out here. If you do BCom, okay, there is a subject called Money and Financial System. Okay. This book by R.R. Paul is very nice book. Okay. So money is a matter of functions four: medium of exchange, deferred payment, and value of store. As this does not complete the picture, we may add transferability more. So money is something which has the four functions. Okay, money is anything. Okay, money can be anything which has the four functions. So what are the four functions? Medium of exchange, deferred payment, value of store, and transferability. Okay, so the four functions, as you can see out here, this medium of exchange, deferred payment, okay, value of store, transferability. Okay, so these are the four functions of the money. Okay, now medium of exchange, I have already explained. Okay, that you can purchase by paying some amount of money. So that is the exchange. Okay, that you can also see that there is a exchange of the ownership as well. Okay, like the pen. Okay, before you purchase the pen, who was the owner of those pens? Shopkeeper, obviously. Okay, now once you purchase that pen, you will be the owner of the pen, isn't it? So you can exchange. Okay, you give 10 rupees and you will get a pen. Okay, so this is the function of medium of exchange. Now deferred payment. For example, if you have to make payment to any kind of a person, okay, to your employee, okay, like we get our payments, okay, like a tuition fee or the salary or other kind of payments. So we receive in terms of the money value. Okay, so that is the function of the deferred payment. And value of store, as I've already said, that if you store, if you just keep it, I mean, that 10 rupee note, okay, for the next 5 years or 10 years, okay, and you pull it out after 5 or 10 years, still that 10 rupees note will have the same value. And the last function, that is transferability. Nowadays, because of this UPI, it has become very, very much simple these days. Now you can transfer the amount, like you can transfer the amount to your friend's account or to your brother's account or to your sister's account. Okay, so money, it can be transferred, okay, from one account to the other account. Okay, so this is the function of the transferability. Okay. Now these are the four basic functions. Okay, now if we segregate the functions of money, okay, be it primary, secondary, contingent, okay, so what are these functions? Now let us discuss them in brief, one by one. Primary functions. Now by primary functions, as it is saying, by primary, which means the main function. Okay, what is the main function? Number one, medium of exchange. Yes, money, it acts like the medium of exchange. Okay, and by medium of exchange, it means that the goods, it can be exchanged for money. Okay, the same example, uh, while you purchase the pen. Okay, so that is how you can see the function of the medium of exchange. Like you visit a store and you like a dress, okay, or shoe or any kind of cloth material, okay, any kind of garment you want to purchase. Now that garment or shoe or whatever you want to purchase from the shop, it only can be exchanged for the money. Okay, you give money to the shopkeeper and the shopkeeper will give you that garment or shoe or any kind of item you want to purchase from that store. So that is the primary function of the money, that is the medium of exchange. Now this measure of value. Now what do you mean by the measure of value? As here we already have seen this measurement, okay, this measure. So what is the measure of value? A very simple example: 1 kg tomato, it equals to rupees 40. So this 40 rupees is the measurement for the commodity, that is tomato 1 kg. Okay, so for 1 kg of tomato, you must pay rupees 40. So this is the measurement. Okay, so it acts like the unit. Okay, so rupees 10, rupees 20, rupees 30, rupees 40. So this is the measurement of the value. Like just like we measure distance in case of this kilometer, meter, and centimeter, millimeter. Okay, and we also measure time uh, by hours, minutes, seconds, isn't it? So similarly, we can measure the value of economic goods in terms of the money value. Okay, so the money, it acts like the measure of value. How much is the price of uh, tomato? How much is the price of onion? Rupees 35 per kg. Okay, rupees 20 per kg. Okay, rupees 10 per packet, like kurkure or tede mede. One packet, it costs rupees 10, isn't it? So that is the measurement of the value. Okay, so that is your primary function. Primary functions are only two, that is medium of exchange and measurement of value. Okay, now the secondary function. Now this secondary function, now standard of deferred payments. It's very simple. Like for example, you want to take a loan of rupees 20,000. Okay, nowadays these kind of apps, MoneyView or other types of apps are also there. Okay, various types of apps have come, okay, which give you a guarantee of personal loans and all, but the interest rate is very, very high. Sometimes it goes up to 30%. I have seen this. So don't fall into this pit, by the way. So you want to purchase, sorry, you want to take a loan of rupees 20,000. So loan amount 20,000. Okay, now it has been credited to your account. Now you have to make some payments to your creditors. Okay, so 2,000 rupees, 3,000 rupees, 5,000 rupees. So this way you have to make the payment. So how will you make the payment? Will you make the payment by giving him or her uh, rice or other commodities by by barter system? No, they will not accept this payment of barter system, but they will only understand the language of the money. They will accept only the money. So money, it acts like a standard of deferred payment. You go to any kind of restaurant, okay, you eat food and you want to make the payment, okay, either cash money or nowadays this UPI payment. Okay, so money, it acts like a standard of deferred payment. Okay, so this is the secondary function of the money. Okay, now the second function, store of value. Again, the same example I want to give, that money, it acts, okay, it serves as a store of value that people can accumulate, okay, or store their wealth in the form of money. Like for example, you have 10,000 rupees. Okay, now you want to purchase some item, let's say digital gold. Okay, you have invested money in the market and you purchase digital gold for rupees 10,000. So your money, it will be stored somewhere digitally. Okay, so that is the store of value. Okay, and also the same example, that is the 10 rupee note example. Okay, if you just keep it for 5 or 10 years, and after 5 or 10 years, if you want to use the money, it will still have the same value of 10 rupees. Okay, it will not be depreciated or appreciated, yeah, depending upon the market conditions. Okay, whether it be inflation or deflation, it matters that way, but the value of 10 rupees will remain constant, that is 10 only. Okay, and this transfer of value, by transfer of value, it means that money can be transferred from one account to the other account. If you want to transfer money from your account to your friend's account, it can be transferred. Like whenever we make the payment through UPI, okay, like Google Pay or Bheem, okay, Phone Pay, Paytm. Nowadays, people are not using Paytm. I know that. Sorry, I hope you have already heard about this Paytm issue. Okay, so whenever you make the payment using UPI apps, what happens actually? Money it gets transferred from your account to the vendor's account, isn't it? So this is the transfer of value. This is the function of the transferability that I have talked about out here. Let me just show you. I don't know why it has hanged. Anyway, let us continue with the contingent functions. Now, in the contingent functions, first of all, we have number one, this maximization of utility. Okay, so rational consumer. Okay, this term rational consumer. Okay, this is very uh, a useful term. Okay, and you can observe this kind of rationality. Okay, everywhere. So being a rational consumer, okay, what you want to do? You want to purchase varieties of goods and services by paying less amount. There is a concept that we want the cheap and best. Okay, so that is being economic in a way. Okay, so for obtaining the maximum utility from any commodity, okay, you can use the money. Okay, so money it acts like the intermediate out here. Uh, like in this first semester when we were talking about uh, this cardinal utility analysis theory, okay, where in case of the one commodity case, MUX is equals to PX, isn't it? So the marginal utility that is achieved by uh, consuming X commodity is equal to the price of the X commodity, isn't it? Now, if the price of the commodity, whatever you are paying the price, okay, towards that particular commodity, and the marginal utility also, if we are obtaining of the same value, then it will be in the equilibrium situation, right? So MUX equals to PX in case of the one commodity. So that is how the consumer, okay, they can maximize their utility. Like for example, let me just give you a very simple example, a very practical example. Uh, Let us assume that there are three friends, okay, uh, Sumit and Kanhaiya and Abhas, okay. So they went to a restaurant out here, okay. They want to have a pizza, and let us assume that one pizza it costs rupees 250, okay. Now they want to have a pizza, okay. So if each person pays for the item that is pizza, how much they have to pay in total? They have to pay 250 into 3 equals 750, okay. But they decided that they will contribute the amount together, and they will share the item because the pizza it will taste same only, okay. Yeah, the this flavor it varies, by the way, but overall a pizza it tastes almost same only, okay. So they contribute the money, and they ordered one and they shared the food. So this is the practical example of the maximization of the utility, okay. By spending less money you can maximize the utility, okay. So this is the case where MUX is greater than your PX, okay. This is not the case of the MUX equals to PX, but MUX is greater than your PX, okay. So this is the condition. Now point number two, this employment of factor inputs. Now uh, see, every producer, okay, they aim to maximize their profit. Obviously they want to increase their profit margin, okay. So now uh, if the input cost, is very high, obviously the selling price will also be high, isn't it? So if the input cost, that is the cost of production, is very high, then the selling price will also be high. Now, talking about this cost of production, we have four factors, okay? Land, labor, capital, and organization, or entrepreneurship, or proprietorship, okay? Let us just talk about this land or labor. Now, this land, let us suppose, what we must pay? Rent. So this rent is expressed in terms of the money value. Rent rupees 5,000, 10,000, 15,000. Salary 10,000, 12,000, 15,000, 25,000, 32,000. So this monetary expression of the factor inputs will help the producer to employ a certain amount or a proportionate amount of the factor inputs, okay, because he will have a general idea, okay, he will have a concept that how much money will be paid for the rent, okay, how much money I must pay for the salary. So this is how the factor inputs can be employed proportionately, okay, in a very uh, mm, good manner, okay, in a very efficient manner, okay, in a proportionate way. Now, the third function, distribution of national income. Now, we have already discussed about national income. I don't want to go in detail about it. Now, this distribution of national income, it also is one of the contingent function of the money. Now, this national income, it can be distributed. How? Government, they collect tax from us, okay? And the government now will spend the same money, okay, in our economy for the construction of the roads, okay? Basically, you can say for building up our infrastructure of the country, okay? Now, for example, if you are working in a company, let us say Hindustan Unilever Limited, okay, HUL, you are working as an accountant, okay? Now, HUL, Hindustan Unilever Limited, it is adding into the GDP, isn't it? Now, yeah, this GDP is not the exact national income. So NNPFC is the national income, right? So there is a formula, you know how to convert this and that. So this uh, company, okay, it is adding it into the GDP. Now, when you calculate national income, obviously the contribution of HUL is also included out there. Now that company is giving you the salary, and with that salary you are paying your tax, and with that salary you are making purchase or consumption in the economy. So don't you think this way the national income is being distributed? Okay, there is a channel. Okay, now if you hire a driver, okay, now you have a car, okay, you have a maid also, okay, now you're a rich person because you are earning huge amount of money, okay, working in that company. So this employment will be generated somehow, okay, and the national income, it will be distributed in a very small scale. Now, basis of the fourth function, basis of credit system. Now, this credit system, it's like, mm, what do you say? Uh, this Negotiable Instrument Act, yeah, you have to study in this in college level. So, a credit system, credit, very simple term. You want to take a loan from the bank, okay, for education purpose or personal or home loan or car loan. You visit your bank, and the bank will, they will provide you the loan, isn't it? So how the loan will be provided to you? It will be transferred in your account, isn't it? But that transfer of the amount, it will be in terms of the money value. It will be in terms of rupees. Okay, let us say the amount is 50,000. Okay, it is not 50,000 kg or 50,000 kilometer, but what it is, rupees 50,000. Okay, so this rupees is also the measurement, as you can see out here. This is the measurement of value, and this is the basis of the credit system. And in this credit system, we will be using various instruments, okay, negotiable instruments, just like check, okay, bills of exchange, promissory note, okay, credit note, debit note, Okay, however, this debit note and credit note, they are not actually accepted, but mostly this bank checks, okay, demand draft, okay, or bank draft or bills of exchange, they are accepted. Okay, so these are the functions of money, that is primary functions, secondary functions, and contingent functions. Okay, now let us see what is the next topic. This supply of money. Okay, now supply of money. Now what do you mean by the supply of money? Now supply of money, it refers to the stock of money held by the public at a point of time as a means of payments and store of value. So by supply of money, we actually refer to the stock concept. Now remember, there is a difference between the supply concept and the stock concept, right? Because this supply, this concept, only the supply, uh, it is a time concept, but it is measured over a period of time. Okay, like from the 1st of April to the 31st of the next year. Okay, so this is the concept of money. Sorry, this is the concept of supply. But about the stock concept, on a particular date, on a particular time period. Okay, oh, sorry, on a particular point of time. Okay, like today is 20th of April. Okay, so on 20th of April, how much money was there with us? So that is the concept of the stock. Okay, but supply is over a period of time. Okay. Remember, supply is over a period of time, but the concept of stock is at a point of time. Okay, remember this. So by supply of money, we actually refer to the stock of money held by the public at a point of time. Remember, okay, at a point of time, like on 20th of April, how much money was held by the public? On 19th of April, how much money was held by the public? Okay, on 21st of April, how much money was uh, held by the public? So that is the concept of supply. Okay, and we uh, we have this four measures of money supply in India. Okay, uh, M1, M2, M3, and M4. Okay, like other things were also there, like see this components of money supply. We don't have to go in depth about it because it has been removed for this particular year. Okay, you just have to understand the concept. What is M1, M2, M3, M4? If you just understand from the formula, it will be okay. Okay. Now, what is M1? Now, by M1, we mean the currency notes and the coins that is held by the public. Okay. Now, DD. Now, this DD, it means the demand deposits. In simple term, it is known as the saving account or the saving deposit. Okay, and uh, other types of deposits. Okay, OD. Uh, like public institutions. Okay, if they are, you know, if they are having a deposit of the foreign currency, like uh, like US or Nepal currency or other, dollars, okay, this pounds, okay, euros, okay, if they are holding such kind of deposits, that is referred as OD, that is the other deposits. So M1 is basically your currency and the coin, I mean the currency that is in terms of the currency notes and the coins held by the public, plus DD, that is the demand deposits, okay, with the commercial bank, okay, DD, okay, in simple language, it is the savings account because that is the demand deposit, that is on demand, you can pull out the money. Okay, now other deposits, it can be the deposit of the foreign exchange. Okay, so this is your M1. Now what is M2? Now M2 is very simple, this M1 plus SD. Now what is SD? SD stands for the saving deposits with post office. Okay, not with the commercial bank. So see here in demand, this demand deposits is already included. Okay, savings account. But this SD is a very special type, which is with the post office. You must have observed, or you must have this post office saving account. Okay, because it provides you the higher rate of interest as compared to the bank. So the people, they deposit money with the post office. Okay, so M1 plus the deposit with the post office or SD is your M2. Okay, now M3, what is M3? Now M3 is M1 plus time deposit with commercial banks. By time deposit, we mean uh, mm, the term deposit, okay, fixed deposit for 5 years or 10 years. So that is the measure of M3, okay, and M4. Now M4 is actually your M3 plus TDP, okay. So total deposit with post office savings, but excluding national saving certificates, okay. So you just have to remember the formula, okay, and the concept. What is it? Okay, uh, and other things, you need not go in detail because uh, few things have been removed. Okay, so only the concept basis type of questions will be coming for this semester 2 examinations. Okay, because on 26th I had this orientation. Okay, so out there I came to know this. Okay, so according to that I'm preparing this video. Okay, now the last topic, that is your high powered money. Now what is high powered money? Now, by high powered money, you don't just think that, it's a kind of a complicated money, or it's a super power money, or something different type of money. No, no, no. Whatever the money that we have been seen, okay, whatever the money that is in your pocket, that is in your account, is only known as your money. That is your high powered money, after all. How it is high powered money? Now, this money, whatever the currency notes and the coins that we are using, who has issued that money? Central Bank, RBI, Reserve Bank of India, okay, Central Bank of our country, RBI. RBI has issued the money, okay. So this money, okay, uh, it is superior to other forms of money, like this cryptocurrency only. Now the government of India, they have not given the green signal to the cryptocurrency, but they want to levy tax on such kind of currency, okay, cryptocurrency. So before such kind of tax imposition, so many people were buying cryptocurrencies. Even I purchased bitcoins, but when the the tax was imposed, I sold my share because uh, government charging interest on money. Don't you think it sounds so funny out here? Government is charging uh, interest, okay, imposing sorry, tax on your income. Okay, it is understandable, but imposing tax on your money, okay, like for example, if you have 500 rupees and the government is saying that on that 500 rupees I will impose tax. Yeah, they can impose tax on our income, but they cannot impose tax on the money value, on the money that is in your pocket, 500. But whatever the value of cryptocurrency that you have held, that is you have, okay, in your stock, tax will be charged at the same rate, okay, be it the share of 0.1% or 1%, tax will be imposed. So basically, what is high powered money now? Okay, so in general, high powered money is the money which is issued by the central bank, okay, in an economy, okay, and this money is sometimes known as high powered money or the monetary base. Very simple, okay. The currency notes and the coins that are being issued by the central bank of any economy is only known as your high powered money. Why high powered money? Because this money is highly powered, okay. because this money is superior. For example, if you and your friend, you have discovered your own form of money, okay, you guys are having this kind of a token system, okay, so you guys are doing this kind of transaction among yourselves. So do you think that this kind of token money will it be accepted by the central bank? No, it will not be accepted. In fact, this cryptocurrency is not being accepted by RBI. So whatever the money that central bank issues, that money is only known as the high powered money, okay, and it is also known as the monetary base. Okay, this is a very simple chapter. Please go through. Okay, I'll provide you this PDF. Just go through PDF. Okay, yeah, there are some errors out here as I can see. I'll fix it and send you.